Let me make sure the meeting's at 10.
Yeah. Dan. Yeah. Good morning. Hi, Giancarlo.
Wait a second. Dan, is that a real office?
Dan is in Utah, I believe. Giancarlo?
Yeah, yes, it is. There we go. Good morning. How's everybody?
Good morning. Good morning.
That's a real office?
Yeah.
Yeah, legit.
Do you remember Anchorman or smells of
Yeah.
rich mahogany
Oops, I was
filled with many leather-bound books?
I'm in my dad's old. I'm visiting my mom. It's my dad's old den, and he was really
Nice.
into books. So yeah, this is one of these days I'll get to read all these. But yeah, it's amazing.
I love it. I love it. Well, it is 10:01 on this wonderful Wednesday morning. Thank you all for joining us for our third quarter broker meeting. We have some fantastic guests that are going to be joining us today, and we're excited to hear kind of what they have to say and enlighten us with what they do and how they can help us to grow and how we can help each other. Before we get started, Brian has a couple housekeeping things. I know him and I are on the same computer because we're sitting in the same office. So rather than us having the echo going back and forth, we're just hopping on here together. So Brian, you have a couple housekeeping items?
Yeah, right there on the screen, you can see just to keep the volume down, a lot of conversations going on. Keep yourself on mute while not speaking. Raise your hand feature on the bottom of your screen. It's probably right there next to the captions icon. Obviously, a respectful space. We'll have some notes and some items that this is being recorded. It will be shared on YouTube later, and then we could also send out the links for everybody else that didn't join. And from there, I guess we'll just keep moving on. Just in between the speakers, obviously, we'll have a 2-minute break so we can have questions or any offline items anybody wants to bring up. And that's about it.
Okay. Thank you, sir. So today, we're going to just do a quick welcome to everyone, which I think I already did. We're going to introduce Giancarlo from AFM Lending and Me Casa Tax Advisors. Jay Josephs will be joining us a little bit later from Joseph Group Appraisals. I know appraisals are kind of interesting these days, and to have an appraiser grace us with his presence, we can ask questions. Also, later on in the meeting, September is Realtor Safety Month. So we're kind of going to go over a little bit of how to keep ourselves safe out there. And for the team, we'll go over our third quarter highlights as well. So without further ado, let me introduce Mr. Giancarlo, who I've known for years. Him and I have done deals together, but also I think just for a matter of someone to turn to for different things when it comes to business. So Giancarlo is the owner of AFM Lending and Me Casa Tax Advisors, LLC. He had over a decade of financial services in the mortgage industry and the tax industry. He's built a reputation on guiding families and business owners through two of the most important areas of their financial lives, to include tax planning and home financing. His companies are built on values of faith, family, and finance, and his mission is to provide clarity, education, and solutions that help agents and their clients to succeed. So our initial conversation was the whole package. You know, like it's more than just buying a house, but this is the whole package. And I kind of like the way that he goes about it. As we all know, we have plenty of lending partners. Actually, I can't say plenty. I have 4 lending partners. But this is more than just lending. This is actually a way to expand your business and give additional information to your clients about how we can help them as agents. So without further ado, Giancarlo, I'll have you take over.
Fantastic. Awesome. So pleasure to be here with you guys. Okay. As as Earl was mentioning, I do have a really different perspective on, advocating for the client and helping you guys as real estate agents elevate those conversations, right? So we can get not only more sales, but also guide people through that process that we need to. So what I can definitely say about this is what I want to leave you guys with, in my time with you guys, is going to be a couple of things, right? The first one is going to be identifying sales opportunities. Okay, so you guys can have better conversations with people. I want you guys to be able to figure out, how to communicate financial benefits. And the most important thing of all, right, is how to stay compliant. Because when you're talking about money, we do have a tendency of kind of going into different aspects of things, so when we're creating or ideating with a client for us to be able to guide them through a process, there are going to be certain concepts, right, that we want to bring up to them, but we also want to make sure that we remain compliant, so they don't come back in and say, hey, well, my agent told me this, right, and then now you're liable for lawsuits and, misrepresentation and et cetera, right? So big context of things, that's what the goal of this would be. So let's talk about sales opportunities. Okay, so sales opportunities are pretty interesting because right now we're in a time where people have 2-3% interest rates, right? And they're like sitting golden in their properties. So how do you actually identify other sales opportunities? And you guys have seen, right? People now are moving, selling, doing transactions based on financial needs versus just trying to take an opportunity of a low interest rate. So I want to help you guys have that conversation with clients when somebody says, hey, I want to stay with my current rate, or I'm going to wait until rates come down. Okay, there are going to two basic things that you guys can just mention in brief and have people think about it, okay? The first one is, in order for rates to come back down, we need to realize that during the pandemic, obviously there was a pandemic, within the short period of time, within 30 to 45 days, we lost 22 million jobs in a snap of a finger. Government had to figure out something. So the first thing we need to figure out in order for rates to come down is people have to massively lose jobs. Okay, these are all statistics. You just leave them with that. The second point you're going to bring up is that in order for rates to be down, you actually had something that was called QE, or quantitative easing. You guys remember that? Kind of ring a bell? Okay, so what essentially happened is the government was actually buying mortgages, is what they were doing. So of course they fictitiously lowered down the rate, which promoted, the interest rates to go down and then have more more movement happen in the market. Okay, the reason why this is important is because when somebody tells you, hey, I'm going to wait until rates go down, well, you also have to bring this up. I'm like, okay, well, let's be realistic. What needs to happen in order for you to be there? And it's not realistic. And I'm like, and it's really the truth. Like, I don't really ever see it going back down unless those two circumstances come back into place. Right now, I don't have a crystal ball, so very unlikely. So with that in mind, right, the next step, spotting opportunities. People need to, the financial assistance or the financial world, right, that we live in is all about immediate gratification. Right before this meeting, I had a tax conversation with a client that's looking at buying a house. And I just told them, anytime that somebody looks at building wealth, unfortunately, we have this immediate gratification, right? Where we want things to happen immediately. Well, we want them to be a little bit more patient with this because that's truthfully what happens. I don't know if you guys know this, but Warren Buffett didn't actually make his millions of dollars until he was 60. It wasn't like he was in his 20, 30, 40s and did that. No, he actually waited on that and he continued to invest. So when somebody's looking at, having a conversation with you around real estate, ask them, okay, well, what stage in your financial life are you? Like, are you looking at buying your first property? Are you looking at doing an investment property? And an investment property is fantastic for you guys because think about this. You're going to help them buy a property and they're going to pay off the property. And then they're not even the ones making the payment on it. The tenant is. And by the time that they retire, they have cash flow income and that helps out with them. So if we shift the conversations with people and identifying, hey, are we buying this as a retirement plan for you? It's going to bring a different conversation because then you're like, okay, perfect. So if we're going to use it as a retirement vehicle, then let's look at it a little bit different. versus just trying to create a fix and flip. Okay. Now, understanding, what people are looking for. If you have a higher level clientele, somebody that has, let's say, $150,000 in income, more than likely they're going to be looking at either, selling their departing residence and moving up, or selling an investment property and actually purchasing another one. So I'm sure you guys are familiar with a 1031 exchange, right? You guys have heard about it. You guys know it was like a little bit of the nitty gritty on the back end. All right, so the whole idea is this. We're simply taking all of the money that you have in equity from this property and we're using it for down payment on the next one. All right, so why is that an advantage to people? Because remember that initial retirement plan? If somebody wants to say, hey, instead of me wanting to receive $2,000 at the end of me paying off this property, now they say, I maybe want to receive $4,000 at the end of this, then you're going to have to purchase something that's bigger. All right. Now, how to identify those key pieces? I'm going to give you some very quick timelines. If you find somebody that has an investment property that they bought more than 5 years ago, okay, that is going to be key for you to have a conversation with them about 1031s. Because 5 years ago, they bought properties for a really low amount. And when we're filing taxes, we use depreciation. The depreciation is calculated over 27.5 years. Okay, I know I'm throwing a lot of numbers at you. If you're making more money and you don't have enough depreciation, you're paying income taxes on the amount of rental. That's why. So we're going to have a conversation with them saying, hey, well, maybe we want to talk to your tax person, advisor, CPA, whoever, and let's see if it makes sense for you to sell this property and then purchase something that's a little bit higher in value right now so you can have more depreciation and offset your income so you're lowering down your tax liability. Now, I'm not a tax professional, right? That's what you guys should say. I'm not a tax professional. However, I think that you should have that conversation with them. They will really appreciate you telling them that. Because in the world of taxes, 80% of tax preparers out there don't know how to do a depreciation schedule. So as a lender, when I receive taxes from people, I'm missing that all the time. They're not done correctly. People aren't taking it. It is really important for you to point them out to somebody who's a professional, right? And I don't want you guys reviewing tax returns or anything else. That's not the point, right? But I'm telling you this, that when you're sending it over to a lender, the lender's just taking whatever has been documented there, but they're going to people who don't understand how to create these strategies. And that's where you come in on letting them have those conversations with somebody that actually knows. Okay. All right. So how do you have that conversation without overstepping? Okay. And that's, kind of interesting. Okay. The first thing that I will tell you is I've unfortunately heard this time and time again from real estate agents, right? That they tell their clients, if you're selling an investment property, just tell your tax agent that it was your primary. Okay, let me tell you guys, it is impossible for them to do that. We know. And very simply, we just look at the address that they actually have as their primary residence on the top of the taxes. That's their primary residence. Okay, so we have to be careful with that. I've had situations where I have clients, that have been advised, from tax agents or from real estate agents on selling investment properties. They have these huge amount of profit, right? And they sell the investment property to buy a primary. It is really disheartening because then they have to pay some major capital gains on that. Okay, so having a conversation up front is key. So don't ever tell your clients that. The second thing, of not overstepping or being a good advisor. If you work with a lender or with somebody that tells your clients, hey, let's go and amend your taxes so we can qualify for more income. I will tell you right now that that is 100% fraud. Okay, so you have to be careful with that. Because if they do get audited for that, it will cause a trigger effect of who told you to do what. And that becomes an IRS investigation that doesn't fall on the lending side, it doesn't fall on anything else. So the IRS rule is that somebody needs to claim all of their income and all of their deductions. So if your client doesn't qualify immediately, then the best plan of action is to create a strategy, not to tell them to go and amend the taxes. Okay, so that's where I would say don't overstep into that, because I've had a number of lenders that do that and advise that to their clients, and it's just not right. Okay, you have to be careful with that. Encouraging meetings, with their CPA or their tax preparer or somebody that can advise them on that is crucial for you, because that person that understands what you're trying to accomplish should essentially become a partner to you, right? And how do we get this client there? And then I'll help you sell more properties. And that's where you now get, let's buy one, second, third, fourth, fifth. Okay. And then we create other strategies on the tax side so we can eliminate all of their federal tax income. And I know that you guys go through this too, right? Because you're all making income and profit, and you probably have some pretty tax bills, especially if you're productive. So there are going to be strategies that you can implement with the purchase of real estate that can eliminate, virtually eliminate, right? Your tax liability in current and subsequent tax years. Okay, so it obviously becomes a little bit more of an expansive conversation on that. Okay, so how do we factor this in? All right, so having smart real estate conversations with your clients is going to be key for you, because that is what top producing agents are doing right now. They can identify that there's an issue or that there's something that they might need. Let me give you an example. One of my loan officers came up to me and asked me, this buyer is trying to purchase a new property. Okay, they went to a builder. They're about $175,000 in income. Okay, their interest rate on their primary residence is 2.4. Okay, phenomenal. Okay, now right off the top of my head, I'm like, okay, what other investments are they doing? They have nothing. So this is a family household with 2 kids, $175,000. Great candidate for purchasing a property. They can qualify for $650,000, $700,000. The borrowers didn't want to move forward because their rate was too high. So I told the loan officer, I'm like, let's talk about this for a little bit. I need you to shift the conversation from interest rate to total tax benefit. And I'm like, all I need you to do as a loan officer, right? I told them, look at their tax returns and look at their tax liability. So they're paying $35,000 annually in taxes. That's what the tax liability is. If we put a strategy together where they go and purchase a property that's a little bit higher in purchase price, sure, their mortgage payment is going to go up. But at the end of the year, they would actually end up paying just about $5,000 in taxes, because now we can itemize and we can include other strategies into it. So when you're looking at these higher level income clients that you guys have, it's a great candidate for you to say, hey, let's just not look at the interest rate. Let's see what other benefits there are, right? Because you're not going to be reviewing taxes, but I'm just kind of opening the door for you guys to have the conversation from them. So I would say that is a fantastic way for you guys to kind of shift that on. Now, dealing with investors. Okay, are you guys, anybody here deals with investors? Do you guys like investors? 2, 3, 4, 5 different properties. Okay, so have you guys ever heard of a cost segregation? Yeah, no, maybe. Okay, well, here's what a cost segregation is. Okay, just in a nutshell. When an investor purchases a property, there's a tax code that allows us to do a rapid depreciation, okay, on the total value of the property, not including the land, okay, because land is not depreciable, just the property itself. So we essentially have to create like an appraisal, okay, in dividing everything on the property. So window seals, doors, plumbing, electrical, fans, switches, I mean, you name it, right? All of that has to go into a report. And then what we do is we break all that down, and then those things become a depreciation to that investor, like a rapid depreciation. So what happens is that depreciation goes against their positive income, and it reduces the total amount of federal taxes that they can actually contribute to, or they have to pay on, which allows you to now tell the investor, hey, since you're not going to be paying all these taxes because we're putting this here, save that money so we can purchase another one. And we continue to do that on and on and on. And now, by the way, this is how these people get to purchase these $2, $3, $4, $5 million properties, and they start with 1 or 2 small residences. So you being in consistent connection with what their next step is going to be crucial for it. Okay. So when you're dealing with investors, just simple conversation of like, hey, have you or your CPA talked to you guys about, maybe doing a cost segregation on the property? That's all you need to do. And then they're going to probably ask, well, what is it? What's the advantage? And that's where now you can create the introduction, right? And then we can kind of move forward with that. So I would say that, in the time that I have, right, those are going to be some of the best strategies that you can utilize for that, for you to elevate those conversations with your clients and still stay compliant. Okay, so 1031 exchanges and cost segregations are going to be 2 very simple things. Okay, now I'll leave you guys as real estate agents on a little tidbit with this. Okay, the IRS has they call it a rep status, real estate professional. There's some guidelines that you have to fill in order for you to be able to become that. But what happens is that you guys as real estate agents purchasing investment properties, you can actually do it as you can claim them as a Schedule C on your taxes. There's a number of things that we got to do to verify that, right? But what happens is that you guys can now, if you have losses on those properties, that will actually cross over onto your active income and lower down your tax liabilities as well. So it's some very cool things that you can do. Now, you don't have to be a real estate professional to do this. The IRS code just simply says that you have to have 750 hours on actively looking at real estate and managing real estate in order for you to be able to qualify for this. So your clients can qualify for it too. Okay, so obviously there's more stuff. I'm not going to go into the details on it, but that's what I would say for you guys. And I'm not going to overwhelm you with more stuff, because I know this stuff can get really technical. But wanted to kind of, leave the a few minutes, to see if you guys had any questions for me, because I know I threw quite a bit at you.
Well, thank you, Giancarlo, for that. I know I have my pen is on fire over here taking notes. Brian has about a page of notes as well. But does anyone have any questions? Did you have a question, Brian?
I'm trying to wrap my mind around the investment properties rolling into the Schedule Cs. I'm probably going to have to dive into the weeds onto that one.
Yep, exactly. So that's actually one of the very cool things that we can do. So an easy way to identify that with clients, right? And this actually happens all the time. So let's say that you have a main breadwinner, right? And the spouse doesn't work. Well, if the spouse is actively in the management of the real estate, seeking, leases, tenants and management and all that, they qualify for that. So the wife can actually claim that property as a Schedule C.
Well, a lot of us realtors own short-term rentals.
Yep. Short-term rentals is some of the simplest things for you guys to actually do as a Schedule C as well.
Yeah, so the fireworks were going off in my head when you started mentioning that. So you also mentioned bookkeepers and CPAs as a brokerage. We have a few of our own, one in-house that we use for the brokerage itself. His name is Steve Stowe. So if anybody on this call obviously needs a reliable bookkeeper, I'm sure Giancarlo has a couple as well, but we have one Steve that would be happy to help out, or at least give you a, what is it?
Like consultation.
A consultation.
Yep, absolutely. So I would highly recommend that. Now, I will mention this, with in the world of taxes, just like with real estate agents, just like with loan officers, we all have a different type of business. CPAs are not all built the same. The tax code is vast. It is a ton, and it changes more than what our world in the mortgages and real estate changes. Okay, every year. That you go to one CPA and they're like, no, I can't do that, or I don't like doing that, doesn't mean it can't be done. Right? Or, it doesn't mean that they don't have the strategies or the way to put it together, because some CPAs that I know, they're very, kind of like, this is my box, this is what I like staying in, and that's it. I work more as an advisor. So essentially what I do, right? Let me give you an example of my last client here. So yesterday I had a phone call, with a gentleman that's out of California. He has 15 real estate properties out in California, 2 businesses, and a couple of a commercial real estate, right? He actually owns a building, with medical and everything else. So he approached me, he actually approached a financial advisor of his, and we were in a conversation, and they want to do a DST. Okay, this is a little bit more of an advanced strategy. Essentially what it is, it's called a 1031 or a 721 DST. It's a Delaware statutory trust. Essentially what he's doing is he's selling properties, okay, and then the money goes into a trust that can become an investment vehicle for other people. That's a really simple way to explain it. Anyway, so what I did with him is say, look, if I really wanted to do you a disservice, I would tell you, go with that, you're good. But the reality is that your tax life is a lot more complicated than just looking at one strategy and pretending like everything is going to be fine. So what I do is I pretty much gather all the information from the client, who their heirs are going to be, how old their kids are, how much money they have allocated, insurance, retirement accounts, the whole bit, right? Everything in the financial world. And then we do an analysis and see which strategies are going to be the best for him, depending on what they're trying to accomplish. That's what an advisor does. Okay, a tax advisor does. A CPA does not do that. A CPA says, hey, I'm going to record what you've done in the past, and I'm going to file your taxes. So a lot of times when you come up to them and say, hey, I'm thinking about doing this strategy, what'll work, they'll probably tell you, no, not right now. Or, they'll tell you one other thing, because they're not creating a strategy, they're just recording in the past. So there is differences between those. That's why I speak to you guys in this way of like trying to identify and find other opportunities, is because we are built different. Okay, so I actually have quite a few other CPA partners. I have one that absolutely the only thing he does is foreign income. And I will tell you, foreign income is one of those things that if you have clients, Canadian, Mexican, or just from any other country that receives income from that, it is very, very, very complicated. Like I don't even touch that. Okay, because it becomes so much. But you being able to connect them with somebody so they can create more investments in the US is going to be crucial for you. So, and then also expand your conversations, right? With like, hey, you know what? I have somebody that might be able to help you out with that. So that really is what the goal of this is, is to help you guys out, kind of understand and see different opportunities out there.
Okay, well, I appreciate you, Giancarlo, for all your information. I'm sure his QR code is on the page there. So if you want to scan that to get your information, you can contact him directly. I am sure we'll be talking a little bit further about some of these investment properties. I think there's some things that I need to talk about personally. But I appreciate your time today and the education that you provided for us. I'm sure we'll be in touch. Again, you've been a great resource for me and my business. So hopefully you can do the same for the others.
Absolutely. Thank you very much, guys. I appreciate it. Have a great day.
All right, sir.
Again.
Thank you very much.
Thanks.
Okay, guys, we're going to take a quick break before we bring on Mr. Josephs to kind of talk about what's going on in the appraisal world. But if you guys, I can take questions if anyone has any questions, or we can just take a quick second to let Mr. Joseph get ready. Any questions off the bat so far?